Welcome to TheoTrade. This is Don Kaufman. Here we are, October 24th, 2016. You were watching the Theo Night video. Markets today, specifically the S&P futures, just really started off grinding higher on the trading session, grinding back up to 2144. If I sound fairly unexcited about that level, well, that's because we are unexcited about that level. If you are unfamiliar with some of the levels that we've been talking about here for now, what has become months here at TheoTrade, 2143 happens to be one of the levels. And what did we do the entire trading day? Oh, today was painful. I mean, today we literally just ground above or below 2143. Again, 2143 not being support nor resistance, but more of a concentric, if you will, of where risk kind of lies. Now, again, if you kind of zoom out just a bit, you look at the last, some 30 days of trade, all we've done is just, well, literally jumped from level to level on a day-to-day basis. So the last few trading sessions we've had, again, we've been grinding higher. Well, not necessarily. Last week, we actually clipped right into the 2143 level. We backed off back to 2129 to jump back to 2143. Again, each and every day has this binary effect where you flip a coin. Heads, we trade up. Tails, we trade right back down. And again, the upper level here that we'll keep our eyes open for in the days to come happen to be 2152. Now, let's focus on a little bit more of not so much what happened this last trading session, the present, and more importantly, the future. Apple's earnings are going to be up here in very short order. Again, there's a lot of earnings announcements coming out, but hey, Apple can't go wrong here, right? Well, if you take a look back at some recent earnings announcements, okay, Apple's had some decent sized gaps, nothing too unexpected. And one thing I urge you to do if you're even thinking about trading earnings announcements, number one, you have to realize that these are binary events, right? Earnings come out, stock explodes higher, stock sells off. All we really have to go off of happens to be what's termed the expected move. And what's important is if you're going to trade earnings, you look back at a few, earnings announcements previously. And you just at a glance, you can see decent sized gap over here. Apple ultimately trading from the 96 and change up to, 103. All right. Again, decent sized move. Here's actually a gap down. Apple was trading at 104 after the earnings came in at 97. Okay. And take this to whatever extreme that you're comfortable with. But I myself will look back with a multitude. Very often you get people that say, well, Apple typically trades up before earnings. Yeah, what? On the last 3 announcements? Okay. You look back again over a multitude of earnings announcements. You're going to find something, that statistically speaking, listen, we trade up, we trade down before the earnings, we gap. Okay. These are to be expected. Now, more pressing is looking at the recent run up in Apple, okay, exploding higher, okay, and that's because of the Samsung news that came out. One thing that surprised me, so the Samsung news comes out, the exploding phone. Ironically, Apple explodes higher. Google comes out, releases the phone. Apple seems unimpeded at this point. Well, coming into this earnings announcement, which will be Tuesday after the bell, that's why I'm covering it tonight here on Monday night, Tuesday after the bell, I'm going to take a little bit of a shot. And in this particular circumstance, I'm going to take a bearish shot. Yes, the bear wants to eat Apple. And I'm going to show you a couple constructive ideas for bearish trades. By the way, if you don't like the bearish take on it, that's okay. Flip it over, do a bullish trade. That's what's great about options pricing. It's fair, it's equal. Okay, whether you want to be bullish, whether you want to be bearish out there, you could even be neutral. However, I'm going to take a bit more of a bearish stance, seeing how let's exclude even the last earnings period. Just look at the recent run up here from 102 to 117. And you got to realize on a percentage basis, it's nothing less than awe-inspiring. Does it mean that Apple cannot trade higher? Absolutely not. Of course it can trade higher. It's an earnings announcement. They blow away the earnings, chicken's done. We're going to trade a lot higher over there. Nevertheless, I think it's a quantifiable risk that we can take. And frankly speaking, well, I'm a bear, especially when it comes to Apple. So I'm going to go over to the options chain and I'm immediately going to open up the 4-day options. I'm not going to mess around. I'm not going to go too far out in time. The other thing I'm not going to do is I'm not going to sell options naked in this case. Selling options naked in some of the other earnings that we've seen has been horrific. It's been a disaster. You sold options naked in Netflix, you're going to be wearing that one for the rest of your life. I mean, it's hideous. A lot of the earnings announcements recently have just smoked through the expected move. Well, in this case, the expectations of price movement are about $5. It couldn't be easier than that. It's just $5. Again, those are based on, if you will, the at-the-money straddle. If you add the at-the-money puts to the at-the-money calls, they're trading for about $5 and change, right? So why does the at-the-money straddle, why is that equivalent to expected move? Well, the option pricing is all about price expectations. Meaning if you bought this at-the-money straddle, okay, you would have to move $5 higher or lower just to be able to break even. Or there are going to be people that are going to go out and they're going to sell this straddle, which ultimately means if we move inside the $5, they're going to be warm and fuzzy. I'm not going to take either one of those bets. I don't think a neutral bet is where I want to be right now. Again, I want to take a bearish bet. There's a few ways I can do it. Number one, I always jump to the in-out spread. And what an in-out spread will look like in this case, you could use something like the 119, for instance, 117. That's a $2 wide spread that's trading for right around $1. That's it. Tomorrow, with about an hour or two left to go in the trading day, you just risk a buck to make a buck. Right? Go out and buy a spread for right around $1. And if Apple, coming into Wednesday morning, gets crushed by the bear, I like it. The bear eats the apple. Anyway, if Apple trades down substantially, you're just going to make a buck. It's nice, it's clean, it's defined risk, right? That's bearish trade number one. Now you can flip that over, you could be bullish on there. But number two, well, we're going to get a little cute. Now we're going to go about $5 outside. What does that mean? $5 outside. I'm going to come right down to about these 212s. And you could buy like a 212, for instance, 210 spread. Now this is a $2 wide spread. $2 wide spread that I could buy for 31 cents. But if you're buying a spread that's outside the expected move, and it is in this case, right? If you take 117 and change and you take $5 away, you're in the neighborhood of about 112. So for us to come all the way down to 110, we have to move outside of the expectations. This trade is much more of a shot in the dark, but you're going to pay 30 cents for it. And if you pay 30 cents for it, the spread could be worth as much as $2. And a lot of people like that risk reward. Sure, you like the risk reward, but the probability in the trade is very, very low. That's a-okay. Now, on top of it, some people just hate buying anything. Like, I hate buying anything. Literally, that's what they say. I hate buying anything. That's okay too. So you can go out and you could still buy this spread. And you could try to finance it by going just about $4 or $5 further out of the money. Let's do these 124, 126s here. So what I'm doing is I'm actually selling a call spread in attempt to finance the purchase of the put spread. And it's right around even money. What's the dark side of this? The dark side of this, if Apple explodes higher, if Apple explodes, to the 126 level or above, you're going to lose $2 on this trade. You'll lose $2 in the trade. So all this is really it's getting synthetically short for the earnings announcement. Synthetically short for the earnings announcement. Again, if you've never seen a risk graph for this, I'll analyze the trade. So we'll go in here and analyze the trade. And what do? I make absolutely nothing. If we explode higher, I lose. If we explode lower, I make. That's it. It's kind of a cool, it's not just a coin flip. This one, well, the coin happens to have, a middle ground where you make absolutely nothing. But if we get below 112, I'm massively profitable. We get above 124, I'm crying in my soup. I like it. I like it because, again, some people just hate the idea, per se, of buying premium. So go on both sides of the market for about even money. And tomorrow, during the trading day, at some point, you might be able to put this on for what we term even money. What that basically means is you're not necessarily paying a debit, you're not getting a credit, but it's pretty much an even money spread. And again, I'm intentionally going outside the $5 expectations. Why? because we've had so many other products do just that recently. Let's see if Apple kind of follows suit and does trade outside. Anyway, we'll update you here in the next few days as to the fate of this particular spread. Again, if you don't like the bearish, connotation to it, flip it over. That's it. You got a video here, look at it, flip the trade over, make it bullish, make it neutral. Again, it's an earnings announcement. It's exciting. It's juice. It's skin in the game with a $5 expected move. Tell you what, Apple has the propensity and the capability of moving a lot more than $5. Let's just hope that's to the downside. Thanks everybody for joining us here at TheoTrade. Have a great night. Bye-bye.